Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And this is also known as the diamonds. And last week I drew some trend lines, some forecast lines, and I left them on my chart. I do that each and every week because my goal is to be more or less an ambassador to technical analysis and educate people on how accurate this is as a forecasting tool. And as you can see, once again, we were spot on with the forecast. Now remember, last week here on this green candle was Friday, and none of these candles existed when I did the recording last week. And I always encourage people to go back to last week's report and listen to that recording so you can see, again, the evidence in order to build your confidence in the chart. So none of these candles existed, and I drew this diagonal line with the end of the line being my target. And you can see today we closed almost exactly at the target. We hit the target, but we almost closed exactly at that target. Now, I want to review the reasons why I drew this angle here. If you go back and look at previous up legs, as we call them, you'll see back here, right there, there is an up leg. Right here is an up leg. If you draw a speed line, the speed line is different than a trend line. A trend line, if the prices are going up, a trend line connects the lows, but a speed line more or less dissects the mean. It takes the range over that period of time in that leg, and you draw a line that more or less intersects those candles. Now, I simply duplicated that angle and I extended it out just about 5 days, and there you go. Now, what does that mean for next week? Let me just take one step back here. You'll see that I drew a couple of lines. One was the forecast line, and then I drew this horizontal line up here with a gap fill point. That gap that was formed back here on, now it's June 11th, you'll see the market gap down. 80% of the time gaps fill. So on Wednesday, that gap filled right there, trade right up to that line, and that was an area of resistance that I highlighted on the chart. Now, the other half of my gap rules are once a gap fills, there's an 80% chance that the price will reverse. So what happened on Wednesday? It filled and then it reversed and closing right near my target. Now notice this candle right here. I'm going to magnify that for you so you can see it. That is a red candle that engulfs the previous green candle from Thursday. That's known as a bearish engulfing pattern. So next week, I believe that the markets will drop, the Dow especially, and I'm going to put my target right here because I think the price will gravitate back to this 20-period moving average right around 260.21. All right, so that's my target, the end of that line right there. Now notice again, see the angle that I drew here? It more or less mimics the angle here and here. You see this down trend line or this forecast line that I drew from the week before last is again running almost parallel to this. I know that's a little bit redundant, but I want to make sure everyone is knowing how to draw the angle of the lines when they're forecasting in their own stocks. Now, another reason why I think the price is going to move lower is not just because of that bearish engulfing pattern, but because there's a wide divergence from that moving average, and the rubber band effect will most likely pull it back, right? So I'm stacking all the evidence right now. The volume is increasing on that bearish engulfing pattern, which tells us that on the way down, with the volume increasing, the sellers are getting more motivated. So we always look at volume as it compares to price, and that's bearish. Look at the stochastics. The blue line, that's the K line, is just about crossing the red line, which is the %D, and that will generate a sell signal. Today, the CCI pulled back and just about touched that red line, which is the +100. Once it crosses down below that, then we have what? That's a sell signal, right? So let's look at the cues here, and you can see, once again, left my lines on from last week. And last week, right here, I drew a line saying that we would move up early in the week and then pull back. So Monday, we did just that. We opened up pretty high. In fact, we gapped up on Monday with the cues and then closed lower with this impressive bearish engulfing pattern, and then immediately pulled back from that point. Today, again, look at that as I magnify that for you, closed exactly at the price target that I put last week. Again, remember, there were no candles here last week. Now, I don't want to come across sounding as though I'm bragging about this, because it's not me. I do not have an ability to look into the future. However, I have spent almost 40 years analyzing charts, and I've gotten really good at interpreting the charts. So really, it's the charts that are giving us the information. And all you have to do is learn how to interpret that information. And everything that I'm doing on these major markets can be applied to individual stocks. And that's what I do for our subscribers. And that's what I do for my personal mentoring students and coaching students. I teach them how to do this. So again, if you're interested in learning how to do it, just contact me and I'll show you how to do it. We'll put you in a program that works for you. Anyway, getting back to where we are here, you can see that the price dropped and the stochastics down here is still moving lower and the CCI is still moving lower. Now, this drop in volume on the way down tells us that the sellers are slowing. See that? So it's a little bit different than what we saw in the diamond. So next week, I think the cues can actually go up first, and then I think they're going to pull back, more or less gravitating back to this 20-period moving average. So keep an eye on that. The cues are very, very overbought at this particular point, and in order for me to really drive that home, let me show you something. This is pretty incredible. Look at the monthly chart on the cues. Not only did we recover from the scare that we had earlier in the year, but we blew past those highs, and now we have 4 months. This is a monthly chart on here, and if we close any lower in the next couple of weeks, this is going to be a very pronounced shadow above that candle, which will be very bearish. So we are extremely overbought in tech right now, and if you look at the divergence from that monthly moving average, that's the widest it's been in possibly in history, but definitely over the last 20 years, that's the widest divergence. So I'm not a prolonged bull in tech. I'm looking for shorts. I'm looking for ways to make money on the way down. But just keep that in mind before you take any new long positions, okay? So again, to reiterate, I think we're going to go up earlier in the week and then pull back later in the week. Now let's look at a more broad-based index in the Russell 2000. You can see here I said we would move up. That's what the diagonal line was, with the end of the line being my target. We blew past my target, and look at that. Moved right up to this horizontal line, which is the role reversal resistance. So I'm going to erase this because I think we need to clean that up just a little bit. I think the Russell 2000 is going to gravitate back towards that moving average. You can see the stochastics down here is overbought. The CCI is overbought. It's still moving lower, and that's why I'm going to be more bearish for the Russell 2000 next week. Now let's look at the spiders. Again, hit on all counts here. We hit our targets, and look at that. S&P closed exactly at my target. Let me magnify that for you so you can see. Closed exactly at it. Now, we are at the resistance point here from the highs back on June 9th. I believe that, like the rest of the markets, I think we're going to pull back. Let me get that angle right. I'm looking to the left as I'm drawing this angle. You see that? So I think we're going to pull back to that moving average. Notice how the stochastics is overbought and the CCI is overbought. The CCI isn't turned lower just yet, but that is a doji. That's a sign of indecision usually found at pivot points. Let me point out one other thing, which is pretty phenomenal. Look down here. Last week, not only did I forecast the price action, but I said the CCI would most likely go up and pull back. Isn't that incredible? Look at the high right here. It matches exactly where I drew it last week, and this pullback is almost more or less running parallel to what we saw back here. So if we see any kind of downturn on Monday, even if it's the slightest bit lower, this CCI and this stochastics are going to start hinging lower, and that could very well accelerate the selling pressure. Now, finally, the VIX. Take a look at this. My forecast was lower on the VIX because it's inversely related to the S&P. We did just that. Came within pennies of hitting that. But what I think we're going to see for the VIX is higher next week. And again, I'm drawing this line that's mimicking this angle back here. I think the VIX is going to go higher, and we haven't seen a pivot point in it yet. But look at this. We have 1, 2, 3, 4 red candles in a row. That's known as a stale red light. We're due for a green one. And any kind of bullish move on the VIX is going to be bearish for the general markets. We have a wide divergence from that moving average. Rubber band effect will most likely pull it back to that. That's why I have my target set right there, matching the moving average. And I'm going to keep an eye on this CCI down here because we came very close to these lows, but notice we have a higher low on the CCI, and that is known as a positive divergence. Okay, so keep an eye on that. Listen, this coming Monday, we are having our open house Q&A. It's on July 20th from 8:30 p.m. to 9:30 p.m. We moved that by a half hour to give our followers on the West Coast a little bit more time to get settled and got their computers on. If you'd like to participate in that, just go to our website, click on the Register Now link right there, and it'll bring you to the registration page where you can just put your name in and your email address and register, and you save your seat. By the way, we do not spam our email list. We do not lease it to anyone. We do not sell it to anyone. It will be protected by the market guys, and it's not going anywhere. We make sure we protect your privacy, and we respect that. So we're looking forward to speaking with you on Monday. Have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.